The coronavirus outbreak and its effects are likely to remain centre stage so far as wider market sentiment is concerned in the week ahead. Although, investors will also get the chance to mull over the policy response from both governments and central banks. The US Federal Reserve is due to release its latest interest rate decision on Wednesday the 18th of March, and the Bank of Japan will make an announcement on the 19th. Now, the US central bank has already acted, cutting interest rates by half a percentage point to 1.25% on the 2nd of March. The Japanese, meanwhile, have been dropping heavy hints about more quantitative easing, or QE. Further actions therefore possible, especially in America, where the CME FedWatch survey shows that investors believe another cut is certain next week. And the only issue is how big: a quarter point, a half, or even 3/4, all the way down to 0.5%. We can see the trajectory of US monetary policy here over the past decade in terms of both the headline Fed funds rate and also the size of the Federal Reserve's balance sheet. That's a measure of its QE program. Global share prices have yet to stabilise in the wake of the 50 basis point cut earlier this month, and the Fed might not want to do anything that smacks of panic. Equally, nor will it want to be seen to be behind the curve, so Chair Jay Powell's got a tricky balancing act, especially as questions are increasingly being asked of Fed policy on 4 fronts. 1. Is it being driven by politics or economics? President Trump's howling for more cuts, though Mr. Powell always flatly denies this is a consideration, even though this is an election year. 2. If policy is being driven by economics, is the Fed focusing on the real economy or the financial markets? You'd hope the former, but the Fed is developing a bit of a habit of sticking its hand in its pocket every time the US stock market wobbles. That raises the issue of moral hazard as well as the risk of market bubbles. 3. If the policy is being driven by concerns about the real economy, will a rate cut actually help? It certainly won't make someone get on a flight from Miami to Milan, for example, if they're frightened of the virus, not least now because Milan's shut. And 4. Is the Fed leaving itself with enough ammunition for if and when the next recession comes? And in the end, if not, what can it do about it then? The likely options are then negative interest rates, more QE, and even helicopter money. Japan's got even less room for manoeuvre, as its headline base rate is already minus 0.1%, and the Bank of Japan's balance sheet is already equates to more than 100% of GDP. In the US, it's about 25%. However, this still might not stop Governor Haruhiko Kuroda from taking action. In terms of company news, there is a handful of FTSE 100 firms due to release interim or full year results or host an analyst meeting, and a lot more mid and small cap firms are due to do the same. Reports which could prove particularly informative include those due from the following, though how much they can say is perhaps open to question. Ferguson, Antofagasta and TI Fluid Systems on Tuesday the 17th of March. British American Tobacco Ferrexpo on the 18th. Next and One Savings Bank on the 19th. And finally JD Wetherspoon on Friday the 20th of March. But for me, the stock that's most capable of causing a fuss in the week ahead is grocer Morrison. It's due to report full year results on Wednesday the 17th of March. As we can see here, the shares have struggled over the past 12 months, and the Bradford headquartered company briefly found itself on the fringes of the relegation zone from the FTSE 100 ahead of the latest quarterly reshuffle earlier in March. Weak consumer confidence may be one reason for the slide. Concerns over the transition talks between the UK and EU another, and how they could relate to tariffs or extra costs and supply chain issues. But the real problem may be competition. Coronavirus aside, of course. The latest monthly UK grocery market survey from consultants Kantar Worldpanel revealed that Morrison's had lost market share again in the 3 months to February, down to 10.2% from 10.4% a year ago. The big gainers, once more, were Aldi and Lidl, and their relentless assault continues. Tesco's just announced a new range of price cuts designed to take on those discounters, whose combined market share now exceeds that of Morrison's by 3.5 percentage points. All of that means analysts and investors will look to 3 key sets of figures when Morrison releases its full year results. The first is like-for-like sales. Morrison's had put together a string of 14 consecutive quarters of like-for-like growth, excluding fuel and VAT, but that's come to an end. Sales in the third quarter dropped by 1.2%, and the Christmas trading update for the 22 weeks of January 5th fell 1.7%. Let's see how the fourth quarter finished. The second is pre-tax profit. For the full year, analysts were looking for a 3% increase to £409 million, although they have downgraded from £421 million a few months back. Just in case Morrison's gives any steer for the year to January 2021, analysts are looking for a 6% advance at the moment in pre-tax income to £433 million. Third headline number is the dividend. Morrison paid out 12.6p a share last year, including 6p of special dividends. For the whole of this current year, analysts are looking for a 3.5% increase in the ordinary distribution to 8.84p a share. Morrison's also paid out a 2p special at the interim stage, so investors will be looking to see if the grocer tops that up at the final stage. Besides those headlines, watch out for progress on the operational targets that Chief Executive David Potts laid out alongside last year's full year results. A drive towards £1 billion in annualised wholesale revenues by an expansion of the supply deal with McColl's, up from £700 million last year. Further progress towards the target of £75 to £125 million of incremental profit from wholesale, services and online, up from £54 million last year. And then further positive cash flow to keep debt low. Net debt ended the first half at £2.4 billion, including £1.4 billion of leases. Thank you for watching, and I look forward to seeing you next time.